So what's the deal with Bitcoin? Is it going to be the cornerstone of our financial future, or is it just a massive bubble waiting to pop? You know, the debate is absolutely fierce, with brilliant people on both sides. So in this explainer, we're going to try to cut through all that noise and get right to the core arguments. Okay, let's jump in.
And you really can't get a more stark contrast than this. On one side, you've got Wall Street giants saying Bitcoin's about to be a totally normal part of any serious investment portfolio. And on the other side, you've got Eugene Fama, a Nobel Prize winner, literally the father of modern finance, saying the chance of it going to zero is pretty much a sure thing. So what gives? How can both of these things be true? Let's break it down, starting with the bull.
All right, so first up, let's explore the argument for Bitcoin not just surviving, but actually thriving. The big idea here is that Bitcoin is growing up. It's moving from being this niche kind of weird internet thing into a legitimate, investable asset for the biggest players in the world.
So why is all the big money flowing in now? Well, a few key reasons. For starters, it's a great way to diversify. They're also really attracted to the wild upside potential. And maybe most importantly, the scary monster of a government crackdown seems to be fading away. And you gotta understand, when a giant like BlackRock gets in the game, it's like a green light for everyone else. Suddenly, the biggest risk isn't investing in Bitcoin, it's being the only one who didn't.
Now, I know what you might be thinking. 1 to 3%? That doesn't sound like a lot. It seems like they're just dipping a toe in the water. But you have to remember the scale we're talking about here. When you're an institution managing trillions of dollars, 1% isn't a toe, it's a tidal wave of cash pouring into the system. And that brings a whole new level of legitimacy.
And if you need any more proof that things are changing, look no further than this. State pension funds are now buying Bitcoin ETFs. I mean, these are some of the most careful, risk-averse investors on the entire planet. We're talking about the retirement money for teachers and firefighters. When they start buying in, it sends a massive signal that the way people think about this asset is fundamentally shifting.
For years, the biggest question mark hanging over crypto has been regulation. It's been like the Wild West. But the feeling now is that a clear rulebook, especially in the US, could be the single biggest thing to unlock the next massive wave of investment. You know, it just removes all the uncertainty and gives us big, compliance-heavy institutions the clear framework they need to really jump in with both feet.
And you know, there's another, more human reason for its survival. Bitcoin now has this powerful, super wealthy class of investors who have a ton to lose if it fails. I saw this great line on Reddit that just nails it. Someone fighting to defend something will always fight harder and longer than someone attacking it. It basically creates this built-in defense force of people who are highly motivated to protect the system.
Okay, so that's the bull case. Sounds pretty convincing, right? But that is only half the picture. Now we need to flip the coin and look at the other side, the powerful argument that this whole thing is built on some deep and maybe even fatal flaws.
And this is the core argument you'll hear from traditional economists. Eugene Fama puts it bluntly. Bitcoin just fails the most basic test of what a currency is supposed to be. It's not stable. I mean, think about it. You can't really use something to buy a coffee if its value might get cut in half by the time you walk out of the store. Its crazy volatility undermines the whole original point of it being a new kind of electronic cash.
And here's the cold, hard technical reality behind that argument. The Bitcoin network, it can process maybe 7 transactions a second on a good day. Now compare that to Visa, which is humming along at around 24,000 transactions every single second. That's not just a small difference, it's a colossal gap. It suggests Bitcoin just isn't built to handle payments on a global scale.
Then there's the issue of decentralization, or maybe the lack of it. It's kind of ironic, right? The whole sales pitch for Bitcoin is that it's decentralized, that no one's in control. But when you look at the data, the reality is different. As of late 2024, just 3, that's right, 3 mining pools controlled over 80% of the network's computing power. That much concentration of power raises some really serious questions about how decentralized it truly is.
But beyond all the economic debates and the technical problems, there's one really big existential threat looming over the entire crypto world. It's a threat that some experts think the market is just completely, blissfully ignoring.
And that threat? It's quantum computing. This quote from mathematician Eli Ben-Sasson is just perfect. He says the crypto market is like passengers on the Titanic, partying, with no idea there's an iceberg right ahead. See, the fear is pretty simple. The security protecting every Bitcoin wallet is just a really, really hard math problem. A powerful enough quantum computer could one day solve that problem, instantly. It would be like a master key to every single wallet. Game over.
So, we have these two totally opposite views. On one side, an unstoppable new asset class. On the other, a fatally flawed system. Well, there's a fascinating economic model that actually brings these two ideas together. It shows how Bitcoin's value and its incredible fragility come from the exact same place.
Okay, get ready for this. It's called a rational expectation security utility Nash equilibrium. Yeah, I know, it's a mouthful. But forget the fancy name. The core idea is actually super simple and elegant. It says that Bitcoin's price and its security are locked together in this totally codependent relationship. Think of it this way. Price pays for security, and security creates the trust that supports the price. You can't have one without the other. And when things are going well, this creates a really powerful positive feedback loop. It's a virtuous cycle. It works like this. The price goes up, which means miners make more money. So more miners jump in, which makes the network more powerful and more secure. That increased security makes users feel more confident, so demand grows, which pushes the price up even more. And around it goes.
But here's the crucial point. This is the real catch. The very engine that powers Bitcoin's explosive growth is also the source of its greatest weakness. Because that virtuous cycle we just talked about, it can run in reverse. And when it does, it creates something the model calls a death spiral.
And here's how that nightmare scenario plays out. It all starts with some major negative shock, maybe a catastrophic hack or a huge government ban, something that really spooks the market. The price tanks. Suddenly, mining isn't profitable anymore, so miners start shutting off their machines. As they go offline, the network becomes less secure. People see this, they panic, and they sell, which pushes the price down even further, forcing even more miners to quit. You can see how this becomes a complete systemic collapse.
What's so cool about this model is it gives you a totally new way to look at big market events. Take the Bitcoin halving, for example. The popular story you always hear is that it creates scarcity, so it's bullish for the price. Less supply, price goes up. Simple. But this economic model looks at it and says, whoa, not so fast. From this perspective, a halving is a negative shock. You're cutting the miners' pay in half. All else being equal, that should lead to less security and a lower price, not a higher one. It really makes you think.
Okay, so we've explored the bull case, the bear case, and this really delicate economic balance that holds the whole thing together. So the big question is, what are the key signals you should actually be watching to see which future is playing out?
Think of this as your personal dashboard for Bitcoin's health. On the bull side, you want to watch the institutional money. Are ETF inflows still strong? Are more pension funds getting in? And are we getting closer to clear regulations in the US? On the bear side, the key things are the network hash rate, that's basically your security meter, and whether transaction fees are growing enough to one day support the miners on their own. And of course, keep an ear out for any real breakthroughs in quantum computing.
So at the end of the day, here's where we are. We've seen the powerful forces that could push Bitcoin into the mainstream, and we've seen the fundamental flaws that could trigger its total collapse. It all really comes down to that delicate feedback loop, that dance between price and security. So the question to leave you with is this. Is Bitcoin's unique economic game just a fragile house of cards waiting for a strong gust of wind? Or is it actually the blueprint for a whole new financial world? The truth is, the outcome is